Risk and Return, Part 1. This is the first of two readings related to risk and return. In this reading, we'll cover some basic concepts and then more details will be addressed in Part 2. We'll start out by talking about the investment characteristics of assets. And with respect to the investment characteristics of assets, we have different return measures and then different risk measures. We should recognize that when we talk about an asset from an investment perspective, then obviously we are concerned about the sort of return we might expect and the type of risk that we are taking. For return, there are many different types of measures, and that's what we will discuss first. Then we'll talk about different risk measures. So here, the most basic risk measure is standard deviation or variation from an expected value, but then there are also more advanced risk measures such as skewness and kurtosis, and we'll cover those measures also. Then we'll move on to risk aversion and portfolio selection. Risk aversion has to do with the concept that most investors do not like risk. So all else equal, if an investor has access to two portfolios A and B and the expected return is the same, then a risk-averse investor will prefer the portfolio that has lower risk. The next segment will be about how we calculate portfolio risk. So if we have a portfolio with multiple securities, obviously each of these securities have their own level of risk. But what about the risk of this overall portfolio? How do we calculate this portfolio risk? That's what we will discuss here. And then the final part of this reading is about the efficient frontier and an investor's optimal portfolio. The idea here is that at different levels of risk, we can have obviously multiple portfolios, and the efficient frontier tells us what is the highest return or the highest expected return at each level of risk. And that becomes our efficient portfolio. An investor's optimal portfolio should be on this efficient frontier. As you've seen before, return can come in two forms. Either you can have income. For bonds, you would get coupon payments or interest payments. If you invest in stocks, you would get dividends. Or you can get return in the form of capital gains, where you buy an asset for a certain price and the price or value of that asset goes up with time. You need to understand the following return measures and their applicability. You have seen these in quant, so most of the material here will be a review. A holding period return is simply the return over a specified holding period. If you buy a stock for 50 and after 2 years the stock goes up to 60, then we say that over the 2-year period or the holding period return is 20%. With a holding period return, we always need to specify the period. When the holding period is not specified, or we simply say that the return is 10%, then the assumption is that this is an annualized number. Arithmetic mean return simply refers to the arithmetic mean of returns. Here, this would make sense if you have 3 different stocks. The first stock returns 10%, the second stock 20%, and the third stock 30%. And you want to figure out your average return, then it makes sense to use the arithmetic mean, which is simply the sum of the 3 returns and divided by 3, which is equal to 20%. Geometric mean is useful when you are looking at time series data. If you have stock A and your returns on stock A over the last 3 years were 10%, then 20%, then 30%, and the question is, what was your mean return? Here it would make sense to use the geometric mean, and the formula for the geometric mean would be as follows: 1.1, which is 1 plus the 10% of 0.1, times 1.2, which is 1 plus the 20%, times 1.3 raised to the power of 1 over 3, where 3 is the number of years. Generally, for time series data or to evaluate the performance or the annualized return over time, we will use the geometric mean. Money weighted return, as we saw in quantitative methods, is simply the internal rate of return. We look at the money that is going in, the money that is coming out, and compute the IRR. That is the money weighted return. It makes sense to use this measure when the investment manager is in charge of the timing of cash flows. So I want you to try this question now, and just to make sure you understand the information. Year 1, 30 million over here means this is the money that we have at the start of the year. Then over the year, the net return is 10%. So how much will this become by the end of the year? 33. Then at the end of the year, we have 33. And then for year 2, the net return is 5%. And for year 3, the starting amount is 35. So this means that the investor must have put in some money. All right, so actually let's work through this together. This is year 1, then year 2, year 3. What's the balance from the previous year? Actually, the way we'll do it is say this is 0. And then the new investment is 30. What is the withdrawal? In this, at the start, there is no withdrawal. Net balance at the start of the year is then 30. Investment return for the year, that's given 10%. What is the investment gain? 3. Investment gain is 3. And balance at the end of the year? 33. This becomes the balance at the start of year 2. So since this matches what is given, that means that there is no new investment and there is no withdrawal. Balance at the start of the year is 33 as given. Investment return is minus 5%. So how much do we have at the end? So how much do we lose? 1.65 is the loss. So how much do we have at the end of this exercise? So we have 31.35 at the end of the year. This becomes what we have at the start, but we are told that this is how much we are starting with. So what does this mean? This means that there must be a new investment. So how much money goes in? So 3.65. So there is no withdrawal. The net investment is 3.65. What's the investment return? It is 15%. And in dollar terms, how much did we gain? 5.25. And how much do we have at the end of the year? 40.25. So this is a very straightforward calculation. The question now is, what is the money weighted return? For the money weighted return, you need to look at the exact cash flows. You plug those cash flows into the calculator and get the return. So what's the cash flow at time 0? You take minus 30, take the investor perspective. If money is being put in, that's a minus. If money is being taken out, that's a plus. Then what is cash flow 1? Cash flow 1 means, was any money put in or taken out at the end of year 1, which is the same as the start of year 2? Which is actually, this is cash flow 1, but you are looking over here because these numbers represent the start of year 2. I hope you recognize that start of year 2 is exactly the same as end of year 1. So cash flow 1 is 0. Then what about cash flow 2? Here you are looking at these numbers. So is this money in or money out? This is money put into the project or into the investment. So this will also be minus 3.65. And then cash flow 3, the way these sorts of questions work is at the end of the investment period, which is end of year 3, you are actually taking the money out. So how much do you take out? You take out 40.25. These are the numbers you plug into the calculator and compute the IRR. So, which is shown right here. So all the numbers are done for you. You plug in the numbers and you get an IRR of 6.62%. A more complicated version of this question is available here, example 1. But my contention is that if you can do this, then you understand the concept. On the exam, you are more likely to get something simple that tests the concept rather than something complicated in terms of calculation. Now let's look at the time-weighted rate of return. The time-weighted rate of return measures the compound rate of growth of $1 initially invested in the portfolio over a stated measurement period. Let's take the same example where we invest $20 and then we purchase a second share, we get a dividend at the end of year 1, and then we sell at the end of the second year. So the exact same cash flow, but when we calculate the time weighted rate of return, it will be a little different. To compute the time-weighted rate of return, we need to see what happens to a dollar which is invested at time 0. So notice that the investment at time 0 is $20. At the end of the first year, the stock has gone up to 22.5, plus there is a dividend of 0.50. This means that we have received a return of 15%. So 20 essentially becomes 23, so the return is 15%. A dollar invested over here has now effectively become $0.15 at the end of one period. Then for the second period, we again need to determine the return. A stock that was purchased at the beginning of the second period for $22.50 became worth $23.50 at the end of the second period, and there was a dividend of 50 cents, which means that investment of 22.50 at the beginning of the period essentially gave us 24 at the end of the period. This amounts to a 6.67% return, and the 1.15 that we have at the end of period 1 can then be multiplied by 1.067, and that will tell us how much this initial $1 has become at the end of period 2. And the number we will get is 1.2267. But we need to say what the growth rate has been on average each year. For that, we need to compute the geometric mean. And we do that by multiplying 1.15, which is this number, by 1.067, and then raised to the power of 1 over 2 because we have 2 periods, and we get 1.1075. This means that each period, on average, the rate or return is 0.1075, which is the same as 10.75%. So the time weighted return is 10.75%. Let us look at a few subtleties related to the time weighted return. The first one is how to deal with inflows and outflows during the year. In the example I just showed you, the inflows and outflows were happening at the end of the year. Let's say that we have inflows and outflows at the end of every quarter in a year. So this is 1 year, and each point over here represents the end of a quarter. What we need to do is compute the return for every single period. So first quarter, the return, let's say, is 10%. In the second period, the return might be 5%. Then let's say it is minus 10%, and finally plus 20%. So what we do is for each sub period within a year, we compute the returns and then we figure out what happens to a dollar invested at the start of the period. What is the overall return? And the calculation is straightforward. We multiply this by 1.1 because if there is a 10% return in the first quarter, then the dollar becomes equal to dollar times 1.1, which is 1.1. And then we multiply by 1.05 because there is a 5% return, and then multiplied by 0.9 because we have a 10% decline. So whatever value we have at the end of year 2 will go down by 10%, and we express that by multiplying by 0.9. And then finally the fourth quarter is good, up by 20%, so we multiply by 1.2, and this should give us 1.2474, or effectively the return over the year was 24.74%. The other tricky item is dealing with negative numbers, and we've already done that over here. Notice if the return is negative, then we simply multiply by 1 minus that number. So 1 minus 0.1 is 0.9. What you are not supposed to do is simply multiply the direct return numbers. You have to multiply 1 plus R1 into 1 plus R2 where R1, R2, R3 and R4 are the returns for each sub period. And if a return is negative, then this expression will simply be less than 1. So let's look at the overall methodology now for calculating the time-weighted rate of return. We have a 2-year period where cash inflows and outflows are happening at the end of every quarter. And in a 2-year period, we have 8 quarters. And let's say that these top 3 items are done for you, which is price the portfolio immediately prior to any significant additions or withdrawal of funds. We are saying that all these significant additions and withdrawals are happening at the end of every period. Break the overall evaluation into sub-periods based on the dates of cash inflows and outflows. So we have defined these as our sub-periods. Calculate the holding period return on the portfolio for each sub-period, and that has been done. So we have calculated the returns for each sub-period. Then we are supposed to link or compound holding period returns to obtain an annual rate of return for the year. So if you take year 1, to come up with the number for year 1, we simply multiply 0.95 times 1.15 times 0.9, and this gives us for year 1 a dollar invested at the start of the year becomes equal to 1.0816, and then for the second year we multiply 0.8 by 1.3 and so on, and we have 1.248 for the second year. If there is a 0% return, then we simply multiply by 1. So a dollar invested at the start will become 1.0816 times 1.248 at the end of year 2. To figure out the average per year, we have to take the geometric mean of the numbers for the 2 years. So you multiply them and then raise to the power of 1 over 2 because we have 2 years, and we get 1.1618, and the rate then is 16.18. So the time weighted rate of return in this example is 16.18%. Let us now briefly summarize the differences and similarities between money weighted rate of return versus time weighted rate of return. And this is a summary of what we've talked about. Money weighted rate of return is simply the IRR, whereas time weighted rate of return is the compound rate of growth of $1 initially invested in the portfolio over a stated measurement period. Both these numbers, however, are expressed on an annual basis. The money weighted rate of return depends on the timing and amount of cash flows. And you will understand this better when you work through practice problems. But clearly, if you are investing a lot of money just before a period where there is a tremendous amount of growth, then that is good for the money weighted rate of return. The time weighted rate of return, however, does not depend on the timing and amount of cash flows. So, which method is better? The answer is that it depends. Let's say that you are evaluating a portfolio manager who has no control over when he receives funds to invest. If the portfolio manager does not have control over when to invest funds, then the time weighted return is the appropriate measure, because we should not penalize or reward the investment manager based on the timing of cash flow. So in this particular scenario, it would be appropriate to use the time weighted rate of return and not the money weighted rate of return. On the other hand, if you have a situation where the investment manager does have control over the timing and amount of investment, then it makes sense to use the money weighted rate of return. Let us take a look at this practice question now, and I want you to try this before you watch the video. So for the money weighted return, you enter the cash flows as follows. Cash flow 0 is minus 50 because that's your initial investment. At the end of period 1, you spend $60 more on a share, but you get a dividend of 3. So net cash flow is 57. And at the end of year 2, you sell the shares for a total of 150 plus you get $6 dividend. So the total cash flow is 156. Compute IRR and you should get 28.6. That is a percent. For time weighted return, you calculate the return for each period. At the beginning of the period, you invested $50 and that particular share was worth 60, plus there was a dividend of 3. That means you had a return of 26%, or your $1 here at time 0 became 1.26 at the end of the period. For the second period, the return was 30%. So the dollar here became 1.3 at the end. If you think of the dollar from the start of the year, that becomes 1.26 into 1.3. To compute the time weighted return, we need to find the geometric mean of these two numbers. So we multiply them and raise to the power of 1 over 2 because we have 2 periods, and we get 1.2798. This means that the return is 27.98%. Annualized return and portfolio return. Whenever you are comparing investments that are over different holding periods, you should annualize the number so you have a apples to apples comparison. If you have a return of 2% over a 20-day period, how do you annualize this? Here is what you need to do. 2% over 20 days means that a dollar invested becomes equal to 1.02 over 20 days. This needs to be annualized. So you have to raise this to the power of 365, which is the number of days in a year, divided by 20. 365 over 20 represents the number of 20-day periods in a year. And then you subtract 1 to get a rate. So let's come up with the number. Here is what you should get, 1.4353 minus 1, and that should lead you to 43.53%. Portfolio return, this is a straightforward concept that we've seen before. If you have three different stocks in your portfolio, let's say A has a weightage of 50%, B has a weightage of 25%, and C has a weightage of 25% also. The return on A is 20%, the return on B is 20%, and the return on C is 40%. What is the portfolio return? All we do here is take a weighted average, which means we multiply the weight by the returns and then sum up the numbers. The portfolio return here would be 22.5%. Looking at some other return measures now, gross return is the return earned by an asset manager prior to deducting management fees and taxes. This measures the investment skill of a manager. If you give some money to an investment manager to manage, and let's say that for every $100 that you gave, the investment manager generated overall a 20% return, so 100 became 120. The gross return here is 20%. This is a measure of the investment manager's skill. Let's say that the investment manager charges a 2% fee, which covers the investment manager expense and other administrative expenses. These expenses are subtracted to come up with the net return. Once you pay the 2%, your net return is 18%. In a sense, that's what you are getting. So 18% is what you as an investor are interested in. But to evaluate the performance of a manager, you look at the overall gross return that he generates. If you have another manager who's generating a 24% return, but it just so happens that the other investment manager has a very high investment fee of say 7%, over here the net return is going to be a little bit lower. It will be 17%. But if you are purely looking at the skill of manager A, who gives 20%, and B, who gives 24%, the skill of manager B seems to be better. And again, the point is that gross returns can be used to measure the skill of a manager, but what you are more interested in is the net return, because these expenses need to be paid by you. The pre-tax nominal return is the return before accounting for or before subtracting inflation and taxes. This is the default unless otherwise stated. The point here is that when we say an investment is returning 18%, this 18% is the pre-tax nominal return. Let's say that the tax rate is 30%, or let's make it simpler. Let's say that the tax rate is 33.33%, which means that the after-tax nominal return would be 18% minus the third of that number. So the subtraction would be 6%, and your after-tax nominal return would be 12%. What we are doing is the return after tax is equal to the return before tax into 1 minus the tax rate. The tax rate here is 0.33. The return before tax was 18%, so we have 18% into 0.66, which gives us 12%. The real return is the return after accounting for taxes. Here, by accounting for, we mean subtracting. We've already subtracted taxes here. If we also subtract inflation, let's simplistically say that inflation is 10%, and we are subtracting the 10% number and end up with 2%, then this 2% is the real return. This is the return that we get after taking into account inflation and after taking into account taxes. So ultimately, this return is what investors are most concerned with. What I have shown here is a simplistic and approximate calculation where we subtract inflation from the nominal after-tax rate to come up with the real rate. The more precise formula is given right here. 1 plus I stands for the nominal after-tax rate, is equal to 1 plus R, where R is our after-tax real return, multiplied by 1 plus pi, where pi stands for inflation. If we use the same numbers, the nominal after-tax return is 12%. So we have 1 plus 12%, which is 1.12, is equal to 1 plus the real return into 1 plus inflation. Inflation is 10%, so 1 plus 10% means 1.1. When you solve for R, you will get 0.018, which is approximately 2%. When you solve for R, you will get 0.018, which means that the real return is 1.8%. Notice that the approximation of 2% was reasonably close to the 1.8% number. If you get something like this on the exam and your answer choices are very close to each other, then you should use this precise formula. If the answer options are pretty spread out, then you can use this approximate calculation.